Good afternoon, and thank you for joining me at the 103rd Annual NAFS Convention. This is my first convention, but I'm excited about speaking today to you about food and beverage M&A activity. As I was putting together my presentation, I realized that today would have been the 90th birthday for my father, who passed away a couple months ago. And as I was putting the presentation together, I was thinking back at lessons learned and how they might apply to what we're going to talk about today. And one in particular came to mind. I grew up on a dairy farm in upstate New York, the youngest of 6 children and the youngest of 4 brothers. And our job during the summer was to put hay in the barn to take care of the cows over the winter. We grew up poor with not a lot of new things, but this particular summer, my father had gotten a tractor that was new, or at least new to our family, a brand new baler and a brand new hay wagon. So our job was to be down at in the barn putting hay in there, and he was up on top of a very steep hill behind our house, baling hay. My oldest brother was in charge of bringing wagons down so that we could unload them into the barn. And on this particular trip, he'd gotten off the path and tipped the wagon over on its side. We all ran up there to help him, not knowing exactly what we were going to do, but we were going to try to get the wagon back up on its wheels. We were working on that. We looked over our shoulder and we saw our dad park the tractor on the hill and start walking our way, which typically wasn't going to be a good thing for us boys. Eventually, we did get the wagon back up on its wheels, but then we looked over our shoulder and we saw the tractor, the baler, and the wagon heading straight down the hill before it crashed into the road and became a big ball of John Deere mess. I may have forgotten to say that my father was an Olympic gold medalist in swearing, so we expected the outburst to be rather large, but instead he turned, he looked at us and said, "Boys, we got a lot of work to do," and he walked away and got to work. And I think that's going to be applicable as we talk about M&A in the food and beverage space here a while longer. I thought I'd start by sharing a little bit of information about M&A by the numbers. So historically, if you look back over the last several years, there's been somewhere in high 300 to mid 400 transactions done annually. This data on the year-to-date basis is a little bit old, only showing through March of 2020, but again, showing a pretty robust, consistent deal count prior to COVID kicking into place. We'll talk a little bit about COVID here in a few minutes. But as we go and try to look at different subsectors, and again, as we think about ourselves in the ingredient and flavor space, about 6.3% of the transactions have been in that space. When you look at beverage, both alcoholic and non-alcoholic beverage, that's been the primary activity that we've seen in the space recently. And then some ancillary pieces like distribution, co-manufacturing, tolling, those types of places as well. But this gives you a good feel for the different sectors for M&A transactions. So we think about the different types of buyers. Again, historically been pretty consistent, with nearly 90% of the acquisitions being done by strategics and around 12% being done by private equity firms. And again, I think we're starting to see more and more private equity firms be interested in the food and beverage space for lots of different reasons. Again, as we look at kind of the blended ingredients in food and beverage acquisitions that have been done, you can see what the historical multiples have been, anywhere from kind of 10.4 in 2016 up to 12.3 in 2020. Again, you also see it as a multiple of revenue. Again, within that group, flavorings tend to obviously have a much higher multiple than some of the other companies in the food and beverage space. But again, a pretty consistently high multiple, almost tech multiples in some cases, when you start thinking about specialty ingredients and flavor companies. Again, as you look across the different types of sectors for agribusiness, alcoholic beverages, baked goods, and so on, you can see again what the historical pieces have been. I broke out on the next slide here, what the space around ingredients and flavors has been, and really focused on what those multiples look like. Again, as you can see, pretty consistent between 2016 through 2019 and into 2020. Again, that's a blended between ingredients and flavors. So again, you get somewhat of a feel for those transactions. When we think about what drives the higher end multiples, Certainly scale is one of the bigger indicators of that. Pure dollars of revenue and EBITDA tend to drive higher multiples just because the scale is important to the acquirers. Also having market segment expertise is driving higher end multiples if you're very specific in a segment that's hot or an area that seems to be on trend. I think that's certainly helped dramatically. Again, in order to get the high end of the multiples, you got to be driving organic growth that is above the market averages. If food and beverage is in the 3 to 4% range, you've got to be driving significantly and consistently higher organic growth than that in order to achieve the higher ends of the multiple levels. And then, as I mentioned earlier, being on-trend solutions, technology, and capabilities. So again, if you think across food and beverage, the types of trends that are consistently here around sugar reduction, better for you, cleaner label types of things, convenience, those types of trends that are cutting across all the different end segments are very attractive and tend to drive the higher end multiples. And then the customer base, right? Are you dealing with multiple large CPG companies, or are you dealing with a number of really small, growing, disruptive brands? Are you concentrated or you're not concentrated? That view of the customer base will really help drive what the higher end multiples will be able to be achieved. And as you think about the lower end multiples, what are they driven by? I think they're driven by smaller scale, just lower levels of revenue and EBITDA, make it tougher for buyers to pay up on a premium basis for that. Single locations or small geographic reach, again, are difficult as buyers look at how they can grow and expand that business. Again, it's a bit of a challenge if they see too much concentration of that. Organic growth below the market, as I talked about before, if you can beat the market by 1.5, 2 times, 3 times organic revenue growth rates, you're going to be at the high end. And if you're below the market growth rate of 3 to 4%, you're certainly going to see the lower end of multiples. And then also, one of the risks you tend to run is concentration of customer base, right? Is it, too high a percentage of concentration in the top 5 customers, top 3 customers, types of customers, those types of things. So again, those characteristics tend to drive the lower end of the value chain. And then the CEO owner impact. And again, what I mean by that is, are those relationships and key customers tied directly to the owner, CEO? And if he or she were to leave as part of the transaction, would that put the business at risk? Can the business operate on its own without the CEO or owner in position? And again, we see that in a lot of privately owned businesses really trying to understand, is there a robust infrastructure beneath the owner that would allow the business to continue if the buyer would like to operate it as a standalone type of business? And then when we start looking at public company comparisons, again, just for purposes of just being able to try to take a look at things here, you see, again, ingredients and flavors, very large, companies, enterprise values, very, very large. Again, looking at revenue, looking at EBITDA, gross margins, but again, as you look at the enterprise value compared to EBITDA, enterprise value versus forward revenue, and so on. Again, it just gives you a feel. These are obviously much larger public companies in the space, but again, gives you the feel for what people are looking at as they're thinking about M&A valuations. Down at the bottom here, again, you can see it broken out by some end segments as far as what the multiple of EBITDA is in various segments along the bottom here. So again, asked a lot of what are we seeing in the current deal environment, obviously with COVID and other things going on. What are we seeing versus what we saw pre-COVID? I think the deal landscape is returning to pre-COVID levels. We're starting to see a lot of activity that wasn't out there during the last 4, 5, 6 months. Deals that were in progress pre-COVID continue to move forward. I think we've certainly been able to close a couple ourselves, and I believe others in the space are seeing deals that were in flight prior to COVID kicking in, that they're able to get those across the goal line. New deals and deal flow, I think, has picked up quite a bit in the last 2 months. So again, I think we're starting to see positive signs there. Obviously, always a concern with what's going on with COVID and the impact it has on the economy, but deals flow has certainly picked up in the last couple months. Again, I think where we're seeing, for the people I'm talking to in the space, more generational change opportunities, as families and people who own their businesses privately have spent some of the time during COVID taking a look at their risk profile and really assessing what they'd like to do over the coming years and looking at the window of opportunity. I think right now where multiples are high, cash is available and deals can be accomplished, we're seeing more activity in some of those areas as well. And good deals can always get done. Right? The segment is seeing strong volume of high quality deals. Good deals can always get done. I think when you see deal flow start to slow down, it's really those fringe types of deals that could be good, could not be good. They struggle to get accomplished, but right now, good deals can always get done. And again, I think the volume and the flow is starting to look like it was pre-COVID. So what's the COVID impact having on valuation and deals? I think we're starting to see that valuation ultimately is always driven by the fundamentals, right? Is there, consistent performance? Is there revenue growth? Is there solid EBITDA? Is there margin expansion? Those types of fundamentals. One of the things I like about the food and beverage space is that it's very easy to measure revenue. There's real EBITDA. I've done a number of deals in my career, some in food and beverage, some in technology, some in manufacturing. But it's great in manufacturing, food and beverage types of companies because it's tangible, right? Real assets, real revenue, real EBITDA. Again, versus trying to look at technology, on the come revenue, what's going to be the next, EBITDA driver in those types of businesses. It's much clearer in the food and beverage space. One of the things that I've seen as you look at deals is net working capital adjustments and calculations are more in depth than they were before. I think as we think about COVID and the impact it's had on supply chain, has had on customer payment cycles and so on, that can just be a more complicated factor than it has been historically. Due diligence has always been a critical part of the deal, but I think even more so now than previously. I think people are really looking much deeper into it to really understand what's happening in the business, right? Is it a negative blip from COVID and therefore we expect it to bounce back? Is it a positive blip because of COVID and do we expect that to continue and so on? Again, one of the probably uniquenesses of the food and beverage space is that COVID has had a big impact, positive and negatively on a lot of companies, just depending on what their customer base and areas of expertise were. In the B2B side of things, again, really, I think focusing all the way through to look at what the customers of the targets are and the dynamics in those end segments. So again, I think that's more unique in more recent deals to really try to understand, again, if somebody's saying, hey, we were down because of COVID and we were heavy in, schools or airlines and so on and so forth. Okay, they're looking through to make sure that makes sense with what's going on in those end segments. If you're up because of similar types of factors, looking through and say, is that a sustainable piece that can continue to happen, or are you going to see that kind of come back as COVID changes over time? Then really understanding the supply chain targets, make sure how much vulnerability there is. What's the likelihood of disruption? Is there anything, especially around agricultural products, that make it difficult to import, to export, to do those types of things? So again, I think much more detailed diligence being done in these areas than I think was being done prior to COVID. And again, I'd say start earlier on deals and working through those because it's taken longer to execute before, especially as you're dealing with governmental agencies and some of those types of organizations where working from home isn't the most productive just because of system limitations and so on. I think most companies have figured out how to pivot and work from home relatively effectively, but some of the more older infrastructure and systems and things that the government agencies tend to have make that less effective, and therefore things just take longer to get licensing, permits, environmental reviews, those types of things. So again, I'd say we're starting to see people needing to start earlier on some of those items because of that extra time. So when we look at longer term trends on the M&A side of things, I'd say we continue to see premium valuations on companies that are on trend. right? Whether that's sugar reduction, better for you, the clean label, the convenience, those types of things. Again, I think those companies, again, that are tied to what everybody believes are long-term trends that are going to stay across food and beverage, higher premium valuations for those companies. I also think the food and beverage deals are getting more sophisticated. There's a lot more bankers involved in doing the deals than there previously was. So again, I think as the deals get more sophisticated and the buyers get more focused on diligence, as I mentioned earlier, it's going to be critical to have your information, your data, your reports, all those types of things in order to make the process easier on you and your teams. Again, the more you have in your data, the more you have control over the conversation. So if you're reacting to data requests and trying to find stuff and build it and put it together, you're at a detriment versus if you have data and you can control the narrative and be very proactive, that's a much stronger position to be in as a seller. So, one of the reasons I was asked to speak on the topic is I've got the battle scars to show for our most recent deal that we closed in June. Was the 30th M&A deal that I've done, not all in the food and beverage space by any means, but I've been through a lot of deals from all sides, buying companies, selling companies, divesting companies, taking them public, taking them private. So I've had a fair amount of experience looking at these from a number of different angles. And one of the things that historically some people have asked was, what are those lessons learned? So I kind of did my David Letterman top 10 lessons learned, and these will come from different angles. So as you read through those, it could be from the owner's perspective, it could be from the buyer's perspective, the seller's perspective, your team's perspective, those types of things. So there's a bunch of different perspectives kind of blended into this because I've kind of been on all different sides of transactions. So, one of the biggest lessons learned is really to understand what the market values, right? And again, this can be different across flavors or specialty ingredients or core ingredients, those types of things. But does the market value revenue growth? Does the market value EBITDA? Is the market really focused on contract or the customer base that you have? Is it going to be, are you going to get value out of technology or geographic reach? So again, it's really trying to understand what does the market value, and then really doing a great self-assessment on how does your business model compare to what's valued, right? So again, you can do this as a self-assessment. Certainly you can talk to bankers, investment bankers, and so on, who will give you a flavor for that. But I think it starts with a self-assessment of really, having that look in the mirror and saying, how does my business model stack up to what's being valued in the marketplace today? And then where you see those gaps, what can you do to better align your strategy to match up what's being valued, right? You may not be able to pivot on a dime, but let's say you're looking at a 2 to 4 year runway to look at doing an acquisition if you're looking to sell, or if you're looking to buy, looking at the target, how does that match up to what's being valued in the marketplace? But again, doing this self-assessment and seeing where the gaps are and really understanding what could you do to close some of those gaps, and is it worth closing some of those gaps over a couple year period to make the company more valuable? And then can you get there in those next couple of years, right? I do think, again, as you're looking at that planning horizon, anywhere from now through 3 years, again, I think you should be thinking about, if I'm thinking of an acquisition strategy or divestiture strategy, sales strategy during that time frame, what can I do over that time period to really get myself better positioned from a value perspective? And then understanding what the likely exit's going to be. As I showed you earlier, 80+% of the deals that are being done are sales to strategic, 12% and a growing. I think focus is around private equity and non-strategics investing into businesses. And then obviously the public exit, which again is very small in this space. But again, really trying to understand that, because each of those areas has a little bit of a different focus, whether it's a strategic or private equity focus. Again, there's a little bit of differences between those. So really trying to understand who's likely going to be buying you, because it does have an impact on how you position your business, what investments you may or may not want to make over the planning horizon, and so on. Do you want to run an auction process, or do you want to control the event? Again, I've done both. Done horse races. We've had 87 firms look at one company I was with outside the food and beverage space. Within the food and beverage space, we wanted to do a controlled process and only brought 3 people to the table that we thought were viable. So again, you have to decide that. Your bankers can certainly give you advice on that, but ultimately you have to decide if you're in the sale process. Again, if you're in the buying process, what kind of race are you getting into? Right? Are you getting into 2 or 3 players and you got to be the best there, or are you getting into a flat-out horse race with an auction process? And again, each of those events has a different strategy tied to it, as well as a different reality of potential outcomes. And then if it is a strategic sale, again, what happens if the deal doesn't go through, right? Whether that's an auction process or a controlled event, right? How much have you shown of your cards, or what makes you special during the process? How much attention have you kept on the business? Again, I see in some cases, people get very distracted by the deal process and the core business starts to fade a little bit. So again, if you don't go down that path and sell to the strategic, how long does it take to recover from that? Have you, tipped your cards to some of the key differentiators of the business and so on? So again, I think these are all questions you want to answer before you start thinking about the process. Develop your message. And again, whether that's with bankers, whether it's you're buying or whether you're selling, I think having that message is critical. I'm going to approach it more from the selling perspective. What are those 3 to 4 points of key differentiation in your business versus everybody else out there? Right? And it really has to be pretty concise and nailed down to that 3 or 4 points of differentiation. Again, believe in it passionately, but really limit it to key things that you can support and that you can show either from customers or you can show from historical data and so on, but really keep it clear and concise. Don't have the we could do this and we could do this and we could do this and we could do this type of approach that many times you see in an offering book that says this company has done this, but it could do this and this and this and this and this. I think from a buyer's perspective, that feels like there's not a concise strategy. There isn't differentiation points. And then you also ask your question, well, why haven't they done those types of things yet? So again, I think the more tight and concise that can be, I think you get higher valuations and more buy-in into it versus, it's not about the volume of things you could do. It's about the value of the differentiation that you actually have. And then be open to flaws in your model. We all have them. Every single business that's ever been created has great parts to it and it has flaws. So be upfront about those flaws, address those flaws. Again, control the narrative to the degree you can, because those issues will come out in due diligence, and it's much better to be ahead of those things proactively than it is to be, reacting to a flaw that somebody is trying to throw at you. Assemble the A team. Again, I think I can't stress this enough. Having done tons and tons of deals, this is not the time to be having people reading, mergers and acquisitions for dummies and being 2 or 3 chapters ahead of you on that. I think you really want to make sure that, again, this is likely, if you're the owner or if you're working for the owners, this is likely the single biggest wealth event that's going to happen to them and their families. So you don't want this to be something you're learning on the fly or working with people who do 1 or 2 of these types of things a year. You want to be with people who do this, for a living. So ensure, but also you need to ensure your internal team is up to the task, whether you're going to bring them in under the tent and share that with them. At some point, you're going to have to do that. And are they ready for it? Are they ready to run the business while you or others are focused on the deal? Again, if you're looking at a now through 3-year outlook, maybe it is the time to say, hey, this is likely to go to this type of buyer, and therefore they're going to want to run this business afterwards. Now might be the time to invest in that CFO or in that, head of operations or something along those lines to make sure you have the internal team that's up to the task. Making sure the key people are in place, again, to keep the business on track. Again, it's critical, whether the deal goes through or doesn't go through, that the business stays on track, right? It's certainly from a buyer's perspective, you want to know that the business is continuing to be driven every single day. But again, I think from an owner or seller's perspective, you want to sit back and say, I'm going to have options here at the end to either pull the trigger and do this or not. And I want to keep my plan B of running a great business intact. So again, making sure that people are staying focused on running the business at hand. Then don't skimp on experienced M&A advisors, tax consultants, investment bankers. Again, I know it's expensive. It seems crazy when you sign up with some of the numbers here, both on a percentage basis and an hourly rate type of basis. But what I can say from experience is, as I said earlier, you don't want this to be acquisitions for dummies, chapter 3 that somebody's reading through. When you think about this as a wealth event, when you think about this as tax structure and different ways that you can work through this in the appropriate fashion, you want to think about investment bankers who can get you in front of the right types of people who not only value your business, but can bring the check to the table to close the deal. All those things are valuable. Again, it seems crazy at the time, but I've seen deals done both ways, and I can tell you the most successful deals have people who do this for a living, standing side by side with the parties involved. I think you need to establish rewards up front for your key people, pre-deal and post-deal. You want them to stick around, again, whether you're bringing them under the tent and letting them know about it or not. I think you need to be prepared to say, what am I going to do to make sure that they stick through the deal? And then again, depending on the type of deal structure and post-deal, how do you keep those valuable people engaged? How do you keep them for the buyer engaged? So again, there's a number of pretty straightforward ways to reward people, either through sales bonuses, some sort of equity, phantom types of things. But again, I think thinking through that for your key people, because again, they'll be critical leading up to the deal, and they'll be very, very critical in most scenarios post-deal. So again, making sure that you get the most value out of the transaction may mean giving up some of it to key people to make sure that they stick through, and that the buyers know that, or that everybody knows that you're going to have this talent post-deal. Again, as you think about this from a number of different angles, whether you're buyer, seller, going to be with the business afterwards, so on, really understanding what the business may look like or need to deliver post-deal, right? So if you're the owner, will you stay afterwards? Do you want to stay afterwards? Again, as you think about a strategic or a private equity firm buying the business, there's likely to be a fair amount of change going on. Do you want to go through that? Again, in a lot of cases, this has been your life, your baby. Do you want to be there through that? Some say yes, some say no. Some are able to drive the business forward with additional equity and cash infusion. Some don't want to be a part of the changes that are going on. So again, I think you have to kind of think through what that looks like for you personally. You have leadership in place to carry the business forward after you leave. Again, it depends on the type of deal being done. But again, there's a value premium from a buyer's perspective if you can sit back and say, oh, I can see Susie running this organization after owner-founder steps away, or I can see a leadership team here that can continue to drive this business forward after the ownership leaves, and so on. So again, do you have that in place? What do you need to deliver post-deal? Again, if you're going to be there, if you're going to be a part of that post-deal piece, right? What was this deal put together on? Do you have what you need to deliver that post-deal? I think those are all questions you want to be able to answer. Are the expectations clear, right? And what I mean by that are, was this deal done, and what was the business case of the buyer putting together, whether you're the buyer or whether you're the seller? What's that acquisition business case? And what I mean is it based upon revenue synergies or cost synergies, right? Cost synergies are relatively easy. Okay, I have 2 people doing that. I only need 1 person doing that. I'm going to save money by, eliminating the 1 role here. Revenue synergies are much more challenging, right? They make sense. They look good. Hey, we could put this together with that, and 1 + 1 = 3. The reality is a lot of that revenue synergy is really hard tread work that has to get done in order to make this happen. So what was the deal based upon? What do you got to deliver again if you're there post-deal? If you're putting together a team to deliver this, again, whether you own the new combined business or whether you're working in the new business, what do we have to do post-deal to make this work? And again, knowing that and understanding that, making sure the expectations are clear, tends to make it a better experience for everybody involved. Where possible, again, this is especially for those that are owners and owning business today, looking at an acquisition, wherever possible, agree on a value range up front. So I've done a number of these deals with families and so on, and private owners, and one of the things I ask them to do when I'm working with them and for them is, they don't need to show it to me, but put in an envelope and seal it what you think your business is worth and what you'd be willing to sell your business for. Again, they don't have to share it with anybody, but what I tend to do is ask them to do that and set it aside, knowing that at some point in time we may come back to that, because deals get very, very emotional, and you have to manage that emotion as well as the process. And again, not being the owner in most of these particular cases, I don't necessarily have that same degree of passion as somebody who has built this business from scratch, had to make payroll, had to do those types of things over 5, 10, 15, 20, 30, 40 years. It gets very emotional when you get into a deal process. So you have to manage your emotions as well as the entire process. And for many people, it's the first time and maybe the only time they'll ever go through the process. So it's a very challenging time. And one of the reasons I do agree on the range up front and kind of set it aside is, one thing, you don't want people to give their business away at some point in time and say, well, I'm already going down the path of a deal. So even though it's not what I want it, I'm just going to do it anyway. And on the flip side, you don't want people to sit there and be like, well, that's a lot of money, but I want to try to continue to squeeze and squeeze and squeeze and maybe lose a deal because they get too greedy on the sale price. So again, I've seen this done very successfully. One of the deals, again, I never got to see the envelope. We worked through it, but there was a time during the process where I went to the family and said, hey guys, I think you're getting a little bit too greedy on the deal here. You've gotten lots and lots of things, and I think the deal's going to fall apart if you try to keep continuing to push the envelope. And I never did get to see the number as to what the sale price was or what they had put in that envelope. But at the closing dinner, one of the family members came to me and said, 2 times. And I said, what? He said, we got 2 times what was in the envelope. So thank you for pushing us to get the deal closed as opposed to squeezing out the very last penny. So yeah, it's just a way to try to manage the emotions. And again, especially for those that are privately owned businesses built from scratch with your own sweat, your own cash, your own everything, that emotion tied to a stressful process is managed much better if you have good expectations going into it and you have a way to kind of check yourself as you go through it. Know your numbers. Again, now more than ever, I think, again, as I talked about previously with all the COVID work and all the things that go through with that, knowing your numbers inside and out, because diligence is getting more and more complex and more sophisticated than ever. So again, at least being able to go back 5 years if you can, with good, solid historic information. 3 to 5 year go forward projections. Again, probably closer to 3 years. 5 years is very difficult for anybody to predict. But please don't have a book that looks like the time of death. Heartbeat code, and then all of a sudden there's the 50% increase that's going to happen in year 3 or year 4, right? So again, I think everybody immediately discounts projections that have just an unbelievable hockey stick to them, right? Again, I think it's good to be aggressive and positive and passionate about where you're going, but I think it's a credibility challenge if you've shown 3 to 4% revenue growth a year, for 5 straight years, and then you start penciling in 15, 18, 20% in the out years without any real reason to drive that activity. So speaking of which, as you talk about your projections and you talk about where you're going, don't just let the numbers do the speaking. Make sure you provide some reasons to believe, hey, this is why it's going to grow twice as much as it has before. It's this new product line we're launching. It's this new traction we've gotten in this customer base. So again, what are those reasons to believe from a buyer's perspective, and vice versa? Again, if you're coming in to look at the business, challenging people to say, why would I believe what you put down in your projections? So again, depending on which side of the transactions you're on, what are those reasons to believe what you're seeing in an Excel spreadsheet? Where applicable, clear the noise out of your numbers, right? So again, we've all seen and been a part of privately owned businesses that are tend to be lifestyle businesses. So again, wherever possible, if grandpa's still on the payroll, you probably want to take that out and get your numbers cleaned up, right? If there's a boat that you use twice a year that's run through the company, probably needs to be cleaned out of those things. So I'd say clean the noise out of the numbers as much as possible, because somebody else is going to do it and they probably won't do it as well as you would. And then on the flip side, please don't take all the noise out of the business, right? I've looked at a number of private companies where by the time they cleared out all the costs, there's essentially no operating expenses in the business. So again, I think it's trying to find that right space between these are clear and obvious, lifestyle expenses that are going through the business. But if you strip way too much out, buyers are going to tend to add back, and they'll add back more aggressively, maybe even than you would have had in there. So again, try to clear those out wherever you can. Be prepared for tons of scrutiny, again, especially during COVID-related claims, right? Hey, we're down because of this, but it's going to bounce back. There's going to be a lot more questions about that than there probably historically would have been. Hey, it's a huge bump forward, but we're going to stay at that level. Why, right? There's just going to be tons of scrutiny, especially around things related to COVID. Again, most people doing deals, either buying and selling, have finance backgrounds, right? And they tend to smell blood in the water if the numbers in the models don't hold up, right? So please pressure test those. Another good reason to have strong advisors is to pressure test those. They've seen it all before and can come back and say, hey, you're going to need to be prepared to fight this. You're going to need to be prepared to look at this. But again, I know the numbers inside and out, because again, whether it's private equity or strategic, most deal teams are made up of people that have finance backgrounds and are going to look for that row in Excel to tie to 6 other Excel sheets that they saw 2 months ago. And again, that level of scrutiny is just the norm as to what goes on now in the due diligence process. And it's tough to recover from a big issue in financial due diligence. So again, be proactive. If there's warts, talk about the warts, right? If there's a challenge with the model, talk about it. But it's really difficult from a credibility standpoint and from a valuation standpoint. If you're going down and you're halfway through a deal process and you have some degree of alignment on value and there turns out to be something significant in the financial due diligence, it really tends to be disproportionately punitive to the sellers. So again, just trying to get that stuff out in front and get ahead of that, I think is always good. Again, for those of you especially that are either not owners or you're partial owners or part of an ownership group, you may not always be 100% aligned with the owners or all of the owners, right? I've done a lot of jobs where I've been a hired gun, I would say, working for the owners. And in most cases, I'm going to be aligned with them on everything. But at some point in time, there can be a conflict between your fiduciary duty as the CFO or the CEO or so on, especially when it comes to post-deal responsibilities, right? So again, if you think about it, the larger the purchase price or the multiple, if you're sticking around post-deal, the harder that is for you, right? So there is a little bit of a disconnect that tends to happen. That can be whether that's you're hired gun working for owners, if you're part of the ownership team and you're sticking around while some of the other owners aren't. There's really high alignment through almost all the process, but there can be a time where alignment isn't 100%. Buyers will hold you accountable to everything that happens in the book that's included in the book. So again, if you're sticking around post-deal, everything that's in the book, you need to be able to make sure that you're comfortable with, because ultimately they're not going to remember that the owner said this. They're going to remember, hey, this is what you said as you being the old company, and now I expect you to deliver on that. So again, just make sure you've gone through that and really feel comfortable with everything that's in there. And let's get to the real stuff, right? Post-deal. This is when the real work begins, right? That's when most of the help goes away, right? So all the tax advisors and all of the accountants and all of the lawyers and all of the investment bankers, right? They're gone, right? You turn around post-deal and you all want to high five, and then they're all gone, right? So everybody wants to be a part of the deal, right? Nobody wants to be a part of all the hard work that goes into actually successfully integrating businesses. And the integration and the planning and the execution of that is more important than any of the deal work. So with a really strong integration and execution of that integration, you can actually make up for maybe overpaying a little bit for a business. But no matter how much or how little you pay for a business, if you poorly execute the integration, it's a disaster. And I've seen deals be all sorts of different ways with it. Integration is the most important thing. And whether you're buying companies or whether you want to see your business be successful on the other side, if you're taking on an equity infusion, those types of things, again, this post-deal piece is the most critical piece to it. One of the things I see as a mistake almost every time I see a bad integration is that we assign a low-level project manager to bring the two businesses together. Right? In my mind, you have to assign a senior executive. My role as the CEO, I'm responsible for every integration that gets done in our company. So again, that level of executive needs to own the integration, because again, it's not just Gantt charts and Microsoft project and task lists and so on. There's so much critical pieces that come from culture, from people, from customer relationships and those types of things. So again, in order to drive a successful integration, it's fine to have project managers, it's fine to have people doing that work, but again, your senior level executives need to own the deal. And again, it's very challenging because again, most people want to all be involved in a deal because it's cool and it's sexy and it's exciting. Not a lot of people want to roll the sleeves up and do all the hard work that has to be done afterwards. So again, make sure you got the right people to drive that post deal. Again, due diligence, even though it's getting more and more, it's cursory at best. Right? You're not going to find everything. So again, post deal, if you identify issues, get your hand up quickly and communicate them. Right? It could mean, hey, we're going to have slower growth than we thought because of this. We're going to have higher costs because of that. But again, nobody likes bad news, but nobody likes bad news late. So again, if you see something that comes out post deal, get the hand up very quickly and make sure that gets communicated. And post-deal communication, speaking of which, right, the number one thing I could say, whether you're selling your company, whether you're buying companies, whether you're integrating them, whether you're an owner, whether you're an employee, is you got to answer, what does this mean to me, immediately for all the employees, right? In some cases, it can mean great things. In some cases, it can mean really bad things. But you've got to be able to answer that question, be prepared to answer that question from day one, because nothing else you say will matter until people understand what it means to them. Everything else is just the peanuts teacher talking, right? So again, get prepared to answer, what does that mean to me? I know in one of the big acquisitions I went through, I told everybody, hey, this is going to be the same afterwards as it was before. And a lot of people believe that. And you can see a bunch of people were still skeptical of that, still thinking, hey, we're going to close down facilities, we're going to do these types of things. Then we actually started to bring investments into the facility, and you can see even more people are like, okay, they did what they said they were going to do. They followed through, but there's still that group of people who are like, they're not that dumb, are they? Are they going to put this equipment in here and then shut the place down? That really is stupid. So it takes time and time, but until you answer that, what does it mean for me? Again, that could be a good thing. That could be a bad thing. It could be, hey, you're going to lose your job when we consolidate these facilities and do these things. But you've got to answer that question, otherwise you'll never get buy-in from people to help get the work done. And then when you think you've communicated enough, you're just getting started. You have to communicate over and over and over again. Be consistent in your communication. You can use different styles, different approaches, different mediums, but you've got to be consistent in your communication. People are always going to fill a void in communication with the worst possible thing that could happen. Right? Nobody's ever going to say, Brian hasn't talked to me in a while, so I'm assuming he's going to give me a big raise and promotion and everything else, right? It's automatically the worst possible case scenario. He's not talking to me because he wants to fire me, he hates me, he's going to close this, right? So make sure you're communicating often and repetitively with your team. And again, as I would say, there's nothing more important than the integration, and within the integration, there's nothing more important than to talk to your people. And post-deal integration, there's a million things to do. You got systems to integrate, you got payroll, you got all sorts of things to do. And it's easy to push off talking to people to focus on tasks. Don't do that. Focus on people, because ultimately that's what people are buying, right? They're buying an organization of good people that can do good things. So again, focus on people, whether you're a buyer, whether you're a seller, make sure you're focusing on the people side of things, because ultimately that's going to be the success or failure of the integration. So hopefully those top 10 lessons learned, again, I had the battle scars for a lot of those, and been fortunate to not repeat a number of those challenges as we go through deal after deal. But from a closing thoughts perspective, I would say there's a lot of great companies in the food and beverage space. And those of you guys that are thinking about either acquiring or being acquired, it's a great time to do deals. Money is available relatively inexpensively. I think there's a lot of good companies that were certainly challenged by COVID in 2020. Financial performance may be something that you need to take a look at before doing a deal. But good deals can get done. all the time. I think marginal deals may be a little bit deferred based upon COVID, but there's great deals to be done out there. Great companies that I think can be better with either equity infusions or being brought together with other companies. So again, I think there's tremendous deals to be done out there. But as you think about either going off and acquiring companies or getting your company prepared and going through the sale process, I'll go back to the immortal words of Robert Briggs. If you decide to do that, there's work to be done. Thank you.